Welcome to Taking Stock for the week ending 3rd of February 2023, where this week myself, Tim Lincoln, and our Head of Stock Doctor Research, Kien, Trinh, stream to all things share market. Happy New Year to all of our members, and Kien, congratulations on the birth of your third child.
Thanks, Tim. It is a miracle how life is formed, but it's been 8 years since my last child, so just trying to get used to sleeping with crying babies at the moment.
Oh, I bet it is, Kien, but what a joyful occasion. Congratulations to yourself and you from all of us here at Lincoln, and I'm sure all of our members also wish you well. So yeah, the market, what a positive start to the new calendar year, with the All Ordinaries Accumulation Index up some 6.4% for the month of February. And in the US, the S&P 500 also up 6.2. So incredibly positive start. And it's really interesting to see, Kien, too, that the All Ordinaries Index here in Australia and many of the major US indices as well, and some of the Europeans are really close to their all-time highs. Over the month, we saw a real recovery in the technology sector, and the US in particular, with the NASDAQ up some 10.7%, with a lot of money flooding into those tech-related stocks. Our star growth stocks here in Australia also did really well, up 8.7% for January. And all of our Lincoln managed funds, both here and in the US, had very strong months. And what really is a strong bellwether for the strength of the market is even more the defensive style portfolios, including our star income stocks, were also up very, very strongly. However, the January rally serves as a strong reminder of the dangers of trying to time markets. 2022 is marked by significant uncertainty. We all know about it, including wars, high energy prices, supply chain disruptions, and interest rate concerns. These events contributed to global recession risks and significant market volatility. However, by avoiding market timing, blocking out the noise, and focusing on opportunities in oversold quality growth and income stocks, particularly in the small to mid-cap space, investors would have been well rewarded for their discipline and their patience. Star stocks that recovered well, including Pro Medicus, ID Education, WiseTech, Altium, just to name a few, Kien.
Yeah, well said, Tim. I mean, looking ahead in 2023, we feel that the moderation of inflation and interest rate expectations will be the key driver for equity markets. Now, the US Federal Reserve, they've already started to ease the pace of interest rate increases, believing that inflation may have peaked, with inflation expected to return to the long-term run rate of around 2%. But this moderation in US inflation expectations should result in a similar outcome in Australia, where inflation reached about 7.8% year on year at the end of the fourth quarter. But market sentiment appears to have already turned the corner, and this is supported by the International Monetary Fund's recent upgrade to its 2023 global economic growth forecast from 2.1% to 2.5%. And this is due largely from the recovery in China, whom many of our resource companies are exposed to. And as we head into the reporting season, Tim, it's reassuring to see that earnings expectations for the market have been resilient. And this can be seen with the chart on screen comparing the All Ords index, and that's in blue, to the forward earnings trend. And as you can see, the trend has been quite stable over the last few months.
But Kien, we can't be too complacent, can we? The true testament to corporate earnings will be clarified in company outlook statements during the current reporting seasons, both here in Australia and the US. The All Ordinaries has rallied 16.7% for the financial year to date and is nearing all-time highs, as we mentioned before. So there may be opportunities to lock in some profits, especially across the areas of the market which are vulnerable to rising interest rates that have really started to take effect. Many consumer-related companies are cycling off levels of profitability that were really on the back of those strong saving rates by the retailer and consumer sector, low interest rates environment, and of course the government stimulus that was really influencing those buying behaviours amongst those consumer-related companies.
Yeah, you're right, Tim. This could mean that several of our star stocks, especially in those consumer retail sectors, could come from our star stock portfolios. So we are cautious of the consumer sector at the moment and anticipating growing headwinds over the next few months. For instance, you notice that the share price across most retailers, such as JB HiFi, Super Retail Group, they are recovering on the back of better than expected first half trading updates. Despite, if you have a look at the data, despite a 4% decline in December's retail sales data, and that was well below expectations of 0.3%. And with many of these retailers in our star income stock universe, we will be assessing whether the attractive dividend yields on these stocks remain sustainable. Ultimately, we'll be looking at the trend in free cash flow, Tim, this reporting season, looking at the payout ratios and also those earnings revisions in determining whether a stock can sustain its dividend yield over the next year.
Yeah, it's critical, isn't it, Kien? The sustainability of dividends and the likelihood of continuing to grow profitability from really high levels is what you and your team are really keeping a close eye on. So really look forward to being incredibly proactive during reporting season with the movements of outs and ins relative to those companies' ability to either sustain yields or maintain those very high levels of growth. So looking forward to that. But moving from retail to a more defensive sector, Kien, sleeping device manufacturer and star growth stock ResMed released its first quarter result last week. Positively, the result was above market expectations, with earnings growth expected to rise by 16% this year, which is great. Having said that, why has there been such negative earnings revisions by consensus analysts for ResMed over the last 3 months, Kien? And these revisions can be seen under Golden Rules 3 and 4.
Yeah, that's a really good question, Tim. If you remember, ResMed grew its market share quite strongly over the past year, and that was due to a competitor recall. However, consensus is anticipating its competitor, Philips, to return to the market sometime this year, which could flatten out ResMed's device sales as its competitor tries to recoup market share. But this could explain the negative 3-month earnings revisions. However, the resumption of sleep clinics, which was postponed during COVID, that remains a near-term growth driver for ResMed into financial year 24. So that's why the growth numbers are still quite strong. And now moving on to our corporate calendar, quite a busy week with reporting season starting. We've got Star Income Stock, Bunnings Trust, and that's BWP Trust and Suncorp Group. They will report their interim results on the 8th of February, followed by Arena REIT and Charter Hall Long WALE REIT on the following day. Then you've got Borderline Star Growth Stock Computershare. They will be hosting the AGM on the 8th of February. So our team will be pretty busy over the next few weeks, Tim.
Things are heating up, Kien. And now to Under the Microscope, Kien. And this week we take a closer look at the first half 23 result for distressed debt collections firm Borderline Star Growth Stock and Star Income Stock Credit Corp. And we do note that Credit Corp is currently under review. Remember, the company's core business is the purchase of debt ledgers and the collection of that debt from companies. They also provide short-term unsecured loans to lower creditworthy borrowers. The company's reported a 30% decline in earnings to $32 million, which was well below market expectations of $48 million. As a consequence, dividends also declined by 40% to 23 cents per share. Kien, what was the main driver of this large earnings drag?
Yeah, Tim, the main reason for the earnings decline was due to a rise in what we call credit loss provisions over the period. When financial firms, when they grow by issuing more debt to consumers, they are required to put aside funds, and these funds are called loss provisions. And it's to account for potential credit losses if the portion of the funds are uncollectible. And this provision is recognized as an expense on the profit and loss statement. And that's what led to the drag in the earnings.
Okay, so it's purely through provisions for bad debts, and you know, that's really understandable with recession fears and rising interest rates. However, I noticed that the share price initially dropped but recovered strongly soon afterwards. What was the main reason for this?
Tim, from an outlook perspective, and that's under Golden Rule 3, the company reaffirmed its financial year 23 earnings guidance of between 90 to 97 million, which suggests a slight decline on financial year 22. However, management did upgrade their debt purchasing guidance and also consumer lending volumes for the year. And this is likely going to lead to positive earnings revisions for the next 2 years for the stock.
Okay, I love the visibility and the transparency that the company's providing and the way they're managing their outlook, which is great from a growth perspective. But with dividends declining by 40%, Kien, is the stock still suitable for income-style investors?
Yeah, Tim, for now, the forward gross dividend yield is currently at 4.3%, which is slightly above the market average. Although the company has cut their dividend, management are expected to keep their dividend policy intact, with the payout ratio expected to be around 50%. And with earnings expected to rise, Tim, in the next half, we believe those forecast dividends should remain sustainable. And for those looking to chase the yield, the stock goes ex-dividend on the 21st of March.
Okay, but considering it's under review, Kien, we've got to be a little cautious, don't we, as to whether we start to talk about opportunities, because we really need to confirm that it will remain a borderline star growth stock and star income stock before we get too tactical with the stock, of course. But let's go a little bit early on that one, because the stock has fallen 30% over the year. It has been smashed. And therefore, does this hypothetically represent an opportunity for investors, assuming that they do remain a star growth stock or star income stock?
Yeah, if you have a look at Golden Rule 4, Tim, you'll find that trend-sensitive investors, they would note that the stock has recently triggered an entry point on the SD30 TSR indicator. So if you follow that indicator, it's worthwhile to have a look at that change in the trends. But with earnings growth expected to improve on the back of a resilient economic environment, we believe the stock is attractively priced at these levels, and that's under Golden Rule 5 valuation. You can see that it's trading slightly below fair value. But those who are considering exposure should be mindful of the active risk, Tim. Earnings are highly correlated to economic conditions and could be weighed down by a recession, or if interest rates rise by more than expected, Tim, making it more difficult for Credit Corp to extract debt payments from customers. So just be mindful of these risks before jumping in.
And look, Credit Corp at the end of the day, Kien, it's been a quality business for a long time. Been in our universe, in and out a couple of times of our star stock universe over the years, but generally has had a place there for a long time. And any volatility generally does represent opportunity for this really well-led business that's growing globally. And they've certainly done the most of their opportunities in the US, which was at the time seen to be, you know, an incredibly ambitious task to take on the US market. But they've done that through that exceptional leadership and strong point of difference in their space. But for now, Kien, your team is currently reviewing the financials and attending management meetings. So they're doing their very thorough due diligence into Credit Corp to fully assess the fundamentals before deciding whether we do retain their star stock status. And you'll also be keeping a close eye on the short interest, which is modest at just under 4%. We'd never like to see that short interest under Golden Rule 4 creep up above that 5% threshold. And now to question of the week, Kien. And with reporting season on our doorstep, a really common question presents this time of year. And it is a very useful question. And that's, how can investors utilize Stock Doctor during reporting season to manage their stocks within a portfolio? With so many companies reporting their results over the next month especially, it can be difficult to keep track of everything. But Stock Doctor really does make it easy. First and foremost, ensure that your portfolios are up to date within the portfolio manager. The portfolio manager is world-class. It's got everything you just about need there to manage a portfolio with ease. And we're going to be incredibly innovative with the portfolio manager over the next year or so to make it even more worldly, if you like. Then you can set up alerts to monitor stock announcements and changes to the fundamentals via the alert manager and other features in Stock Doctor. It's all pretty easy, isn't it, Kien?
That's right, Tim. To set up alerts, just navigate to the alert manager under tools, and then you can create a new alert. Just enter in a company code, for instance, and select from 4 alert categories with some key ones, including star stock changes, for instance. Assess the financial health rating change, which is quite important. Earnings revisions, you can have a look at that, or price sensitive announcements. For income investors, you can check the days until ex-dividend date. And even for trend sensitive investors, there's technical triggers like the SD30 TSR. And alerts can also be processed intraday as well, and you'll be able to be notified within Stock Doctor or via email. It's really your choice.
And a lot of those fields, and you touch on it in a moment too, Kien, can be also set up in the watch list. So, another very, very important feature in there as well. But aside from the alert manager, there is also the corporate calendar. Plays a really important role this time of year, which provides a window into what stocks are reporting over the next month or even beyond the next month. Here you can also assess report dates, AGM dates, and ex-dividend dates, and also see what events we've got coming up here at Lincoln Indicators. Just be careful here. If there is an asterisk next to a stock code, it means that the date has not been confirmed. So it's purely an estimate by our system based on how they reported or when they reported last year. So just be a little careful there. Also in this section, the menu on the left includes options to filter on companies, watch lists, and event types.
Yes, Tim. And at the individual stock level, under the 9 golden rules screen as well, you can also access the upcoming corporate events by clicking on the date item at the top of the page. Here you can also see a list of alerts and whether this stock is in your watch list or portfolio.
Fantastic, Ian. And we really have built Stock Doctor, haven't we, to allow our members to really manage the stocks that they're interested in, the stocks that they own, with absolute ease, with all of the features that we're showcasing here right now. But it is up to the member to really exemplify all of the behaviors that a true DIY, passionate and disciplined DIY investor must employ. And last but not least, Kien, reporting season is when our financial health model really, really shines, doesn't it? That's our core competency, our financial health model, allowing our members to quickly conduct due diligence on a company after the release of its results. No other financial health model out there has back-tested with a 95% success rate in helping our investors and members avoid corporate failure.
Yes, Tim, and these tools will help you stay on top of your portfolio during reporting season. And as always, feel free to contact us if you need any assistance. Also, be mindful that the research team will be extra busy analysing these results over the next month, but we will endeavour to return your calls in a timely manner.
Yeah, great stuff, Kien. Well, that's the first one for 2023 done and dusted. Great sitting down with you again and having a chat. 2023 really does stand to be an incredibly innovative year for us here at Lincoln Indicators and Stock Doctor also. So really excited by that, Kien, and can't wait to deliver to our members plenty of new enhancements to Stock Doctor as we start to consider a global product offering. And congratulations once again on the birth of your 3rd child, Kien.
Yeah, thanks, Tim. It's going to be quite a challenging year for me, but also a rewarding one as well. But as you said, for our clients as well, hopefully the markets will continue to roll along nicely, especially the recovery across our growth and income stocks. Remember, quality over the long term will stand to prevail.
Yeah, you're spot on there, Kien, but there will be noise, won't there? So we're going to be mindful of that. And, we mentioned before too, companies coming off these really high levels of profitability, which probably aren't sustainable. So it'll be really interesting to see and keep our ears wide open to these profit revisions and consensus analyst revisions out there in regard to the profitability of companies here in Australia as they near towards their annual reporting season in June. We're expecting companies to announce some earnings drop-offs before then. And also a bellwether will be the US March reporting period as well. See what happens leading up to there in regard to revisions of earnings. So really important little period of time coming up for equity investing. And a reminder too, Kien, to our members that Lincoln Live begins on Monday again, this coming Monday. So can't wait to have our members dialing into that live session with yourself, myself, Matt Schwartz, and Robbie Manfrey. Been really popular last year, right, with the launch of that. And also a reminder that to make the most of all of the tools this reporting season in Stock Doctor. And if you love the platform, as I know most of you do, please feel free to refer a family or friend to the platform. Just click on the link to the right of the toolbar in Stock Doctor, and we'll provide your referral with Rolls-Royce service, as you know we love to provide to you. So let's hope that rally continues and earnings continue to hold, but keep our eye on things that's critical. Take care and have a happy, healthy, and prosperous week.